Today, we're diving into a topic that's crucial for anyone looking to grow their wealth wisely. You see, in the world of investing, we often find ourselves walking a tightrope between big returns and big risks, especially when we're picking individual stocks. If those stocks take a nosedive, well, so does our money. But fear not, because there's a smarter way to navigate this financial maze, and it's called ETFs. Now, picture this, an ETF that offers you a slice of the entire US stock market, diversifying your investments and minimizing those risky cliffs. That's where the Vanguard Total Stock Market Index Fund ETF, or VTI, steps onto the stage. In this video, we're diving deep into VTI and uncovering why it's a must-have in the portfolio of any long-term investor. VTI is like a one-stop shop for investing in the entire US stock market. From tiny startups to massive giants, this ETF has got it all covered. It's designed to mirror the CRSP US Total Market Index, which includes nearly 99% of the US stock market and around 4,000 different stocks. So, when you invest in VTI, you're essentially investing in a piece of the whole market. As of December 2020, the ETF had over $1 trillion in assets under management and a net expense ratio of just 0.03%, making it a low-cost option for investors seeking nearly the most diversified exposure possible to the US equity markets. Now, let's dive deeper into one of the most powerful concepts in investing: diversification. Imagine you're at a buffet with a wide array of dishes. Instead of loading up your plate with just one type of food, you sample a bit of everything. Why? Because if one dish doesn't quite satisfy your taste buds, you still have other options to enjoy. Diversification is like that buffet strategy, but for your investment portfolio. It's the art of not putting all your eggs in one basket. And when it comes to VTI, it's like having access to a buffet of companies and industries within the entire US stock market. When you invest in VTI, your money isn't tied to the fate of a single company. Instead, it's spread out across numerous companies, big and small, from various industries. This smart move reduces the impact of any single company's downturn on your overall portfolio. If some companies hit a rough patch, and let's face it, it happens, others might be thriving, helping to balance out your overall returns. If you want to explore more about the incredible benefits of diversification, I've got you covered. Check out my video dedicated entirely to the topic of diversification and its role in building a resilient investment strategy. While VTI casts its net wide with around 4,000 US stocks in its basket, there's a detail worth exploring. Let's take a detailed look on its holdings. VTI does an impressive job capturing a vast range of companies, but there's a nuance to consider. Some of the mega-cap giants, like Apple and Microsoft, carry a significant weight in this ETF, accounting for around 12.5% of the total holdings. For an ETF that aims to offer broad diversification, this might seem like a bit of an overemphasis on a select few. In fact, when you look at the big picture, a quarter of VTI's holdings are centered around the top 10 mega-cap companies. Yet, before we dive into the depths of concern, let's take a step back. While there's a concentrated exposure to these mega-cap stocks, it's not necessarily a red flag for every investor. Many individuals might be comfortable with this approach due to their familiarity with these powerhouse companies. After all, understanding their businesses and how they thrive in various economic conditions can provide a level of confidence. In fact, a straightforward investment strategy could involve embracing this concentration and simply holding onto the Vanguard Total Stock Market Index Fund ETF. This set-it-and-forget-it approach lets you ride the wave of the entire US stock market without getting bogged down in the weeds of individual stock picking. If you're a follower of my content, you know that I'm a big advocate for dividend investing, and let me tell you why. Dividend growth isn't just some fancy financial term, it's a game changer for your financial journey. Imagine this: you're building a steady stream of passive income through dividends. It's like having a money tree that keeps on giving, year after year. But it doesn't stop there. Dividend growth also has a ripple effect on your investment portfolio. Here's how it works, using our trusty example, VTI. Back in 2012, VTI dished out dividends of $1.67 per share. Fast forward to 2022, and that number jumps to $3.26 per share. Now, let's say you hopped on the VTI train in 2012 with a $10,000 investment, buying shares at $70 apiece. With a dividend yield of 2.4%, you would have received $238 in annual dividend income. Fast forward to 2021, your annual dividend income would have skyrocketed to $466. That's a whopping 96% increase in your income over just 9 years. And the best part? You didn't have to lift a finger. Those dividends were working hard for you while you sat back and watched your investment flourish. And here's where it gets interesting. When the market takes a dip, as we witnessed during the 2020 pandemic, your dividends step up as your unwavering shield. They offer a consistent income flow, regardless of the market's turbulence. And when you blend this with the magic of dividend reinvesting and the strategy of dollar cost averaging, you've just created a powerful recipe for success. I have shed a light on the immense potential of investing in VTI, which stands out as a stellar investment option. By choosing VTI, investors gain access to diversification and broad market exposure, all wrapped up in a single ETF. Pairing this choice with a disciplined approach, such as incorporating a dividend reinvestment plan and practicing dollar cost averaging, can yield substantial long-term rewards and pave the way to the financial freedom we all aspire to achieve. However, it's crucial to remember that every investment decision demands careful consideration. Before committing your hard-earned money, it's wise to conduct thorough due diligence and diligent research. As always, thank you for watching this video till the end. If you found it at all helpful, then please hit that like button and subscribe to the channel. Your support is always appreciated.